but like at some point you have to bring in professionals in certain aspects that like you're not skilled at. I say like if you need heart surgery, you can cheaply try to do it yourself. I'm not sure how successful that's going to be, but
Not as successful at all.
you're better off going with professional. And I say, and we pick and choose when we want to do that, but there's nothing wrong about getting quotes from different tax advisors, same way you do with contract, the same way we do with bookkeepers. Like it's all the same. You just try to find who's the right fit that can understand what you got going on. You can grow with as well.
Welcome to the Share the Wealth Show, where minority professionals can learn to escape the racial wealth gap and catapult themselves into abundance. Your host, Nicole Pendergrass, grew her net worth from being negative to multiple six figures. Join her on her investigative mission to expose secret strategies of the wealthy so we can all have the tools needed to build the life and legacy we were created to possess. Now it's time for the show.
Hi, everyone. Welcome back again to another episode of the Share the Wealth Show. I'm your host, Nicole Pendergrass, and I'm so excited because today we spoke to Larry Pendleton, and Larry has so much information. He's a CPA. He's been a CPA for his own accounting firm for about 8 years, but he has over a decade of experience as a tax preparer, consultation strategist, and doing just a ton of stuff in the tax arena. And he also has about 6 years of experience or more in the real estate and doing buy and holds, and doing some flips, being a joint venture partner, doing accredited like syndications. He's done a lot of things. And why did he get into all of that? If he was working as a W-2 a CPA, then he decided to open his own business, and then he decided to invest in real estate. Why was that? It's because his strategy, his mission is actually to help people achieve financial freedom through real estate investing and tax strategies. And in order to do that, he needed to free up his time so he could have more free time in order to help people with their education in tax strategies and real estate. And so why that's important is because that's why he's investing in real estate, to give himself enough passive income to meet his expenses. And it goes all in line with his mission statement. He needs that free time to help people. And that's what I love about bigger vision type of dreams and goals. And you need to stick in longer for the rest of the conversation, because we also talked about the mindset of minorities versus non-minorities when it comes to tax preparation strategies, and thinking about the big picture and not always just wanting the most refund right now, and thinking about what your plan is for next year or the year after, and what you want to do and what your tax strategy should be now, and how that will affect your ability to do what you want to do in the future. So in any case, let's get to the show, because you don't want to miss the gems that Larry dropped. Hi, everyone. Welcome back to another episode of the Share the Wealth Show. This is where we focus on strategies to grow, build, and protect minority wealth. And today, first, I am your host, Nicole Pendergrass, and I thank you so much for being here with us today. And I actually need to ask you to leave a rating and review if this podcast so far has been helpful for you. If you've picked up any great information that you want to use, this helps. Putting a rating and review helps us share the wealth even further and helps it spread to other people so they can have the same kind of information. But in any case, today we have with us Mr. Larry Pendleton, the great. Hi, thank you so much for being here today with us. I really appreciate it.
Hey, Nicole, appreciate you having me.
Yeah, thank you. Okay, so I just want to jump right in. Let's get started. I read a quick overview of your bio. But what during your journey, I know you started as a CPA first and then got into real estate. What was that transition like? What made you want to start investing in real estate on top of being an accountant?
I appreciate that. So So in my field, you meet a lot of people. You know, everyone needs their taxes done. So you start to kind of see like how me end up picking up a lot of wealthy clients when I was in the public accounting world, and as well as when I started PC Financial Services. So and I always knew the benefits of real estate when it comes to tax savings. But I just never thought that I can be a real estate investor myself. So this is the whole limiting mindset aspect of things. But then my partner, Terry Conyers, who is also a Class A contractor, he was already in the game since 2012, or probably 2011, 2010, really. And and there was one point in 2016, he was like, Larry, I got this property, I got $2 million on my plate at the moment, like, go get FHA loan. I got this agent, got a property manager. Just try it out. You can do it. So really, he's really the driving motivator of what got me going. Because I seen it, I knew the strategies for it, and just like can Larry actually do it? And it took that kick in the behind from one of my good friends to really get me going.
Okay, so. But that doesn't still happen just overnight automatically. You don't go from being scared thinking, oh, can I do it? Because I definitely have had that mindset and limiting belief, what's possible for me. Just from your friend one time saying, you could do it. Was there anything else there? I feel like that's a big jump to say, like, because there's a lot of times I don't listen to my friends.
Well, I guess you have to understand the relationship between like me and him, where like we're borderline just brothers more often than not, and we end up serving as motivating factors for each other. So, like I say, he's very, very intelligent. Like I said, can do all the taxes, but like he really wasn't big into the starting the tax, like doing a whole lot of tax, starting tax business. He just saw the skill set in me. And then we kind of came together and started PC Financials. And so basically me motivated him to do that. And then him motivating me to get involved and kind of seeing deals. And I mean, we walked through a lot of properties first. So I guess I should have threw that caveat in there. There was like, it wasn't the first property that he had. It was just like, okay, I looked at it. We worked with some agents involved. Then just kind of came across one where, like I said, it was a little 3-2 townhome here locally in Norfolk, Virginia. Still have it to today. But like I said, there were quite a few properties that we looked at beforehand that just didn't pan out numbers wise.
Oh, okay. So you know what? That makes me curious. I want to backtrack a little bit in your story. What were you doing before you were an accountant, and what made you open up your own firm?
I was in the public accounting world, so a regional firm. Like I really wasn't a big four, big accounting, like big company type of guy. So started off in public accounting for 8 years, and then because I was eager to start my own thing, I knew there would be a conflict of interest. With that, with working for an accounting firm that does taxes, and then I'll be doing taxes on the side as well. So about the time I left there, jumped around a few internal audit roles. So that's why I kind of got my audit background between doing public accounting as well as a couple of companies outside of that. But at the same time, we were building PC Financials like in the midst of while having a 9-to-5 job as well. So it's just kind of seeing what I wanted the firm to be, size wise, type of taxes and all of that, who I wanted to help, who I wanted to serve. I guess who we wanted to serve, I guess is a better way to put it. So that's how the background, how we kind of built this thing up from the ground.
Okay. And what gave you that bug though? Because most people who are a W-2 employee, I'm a W-2 employee as well. Sometimes it takes something happening to make you want to go out on your own because that's seen as like risky, right? Or at least in a lot of people's mindsets. And that I think that's also a shift in whether your W-2 is risky or if going out on your own is risky. But what was that bug that made you want to try to do it yourself?
First, because I know a lot of people kind of jump into like Rich Dad Poor Dad and all that being being self-employed and all that being an investor. That became a motivating factor, but that was after once kind of getting into the corporate world, and I really wasn't finding like internal fulfillment. Especially because the reason why I got into accounting in the first place, because my dad, like I said, he's self-employed, has his own HVAC business, and just kind of growing up seeing him like work his ass off like every day, and then come around April 15th every year, he's getting killed with taxes. So part of that was why I even got into accounting, because I knew there was a need to help people like him, and I knew I'll probably be in that same position as well. But I knew a lot of people in our community would be in that position as well, because a lot of people go from still paying like a lot of taxes as an employee, but then starting their own business and paying even more taxes. Because and then just not knowing the strategies or really how I like to call it a game. Once you figure out how the game is played when it comes to taxes, then you start to adjust your lifestyle a bit differently, or you start to make different moves and start to hang around different people so that you can get more educated from that standpoint there. So that's where it kind of fueled for me, and then that's when Rich Dad Poor Dad and Find Your Why and all these other books I started to come across, educating myself on it. Is like, okay, I need to really hone in into this niche of serving others, and that's why my mission now is to help as many of our people achieve financial freedom through real estate and taxes, because I feel like that's a huge step for everybody at this point.
Yeah, no, I agree. So I guess you've seen it more, because you're saying that you saw a lot of people, either they're starting a businesses and they're actually end up paying more taxes, when the reason you're starting a business is it's tax efficient, and whatever the motivating reason is behind starting your business. But what were the mistakes that you saw people doing with their businesses that ended up making them pay more in taxes?
Well, it's the realization of, part of it is that when you're an employee, everyone knows you get your FICA taxes taken out, and typically your employer pays half and you're paid the other half. Mm-hmm. The other aspect that people don't realize is that when you go self-employed, you're now responsible for all the FICA taxes. That's additional 15.3% on top of what the government, the federal income tax rate, as well. So that's why it goes from employee being taxed on 30 to 40% of their income to self-employed individuals being taxed on 50 to 60% of their income. And yes, people think like, hey, I can get all these write-offs, and all that, but unless you're actually growing a business, like they're like basically taking their jobs and making it into a business, and you're still an employer or employee of your own business. But unless you're expanding and doing certain like elections to be taxed favorably, you're always going to be hit with that additional tax on your full net income. So that's one end of the spectrum, when people just like kind of making a lot of money and like not really strategizing their entity or their corporations ways so they can be more tax efficient. From there, the other spectrum of it is that people write off too much, and they're writing off everything because they don't want to pay any taxes and they don't want to show any income, and then they're trying to get a loan. It's like, okay, you're not showing any income from your business. So there's a delicate balance like between the two, and that's what people have to learn about if you're doing an active business. Like when is the right time to be an S corp, when is the right time to be a C corp, how to pay yourself a reasonable salary, because just being an LLC isn't enough from that. And then how to like run expenses through the business properly so that you have the proper documentation. Because like I say, I tell people like I'm very aggressive when it comes to finding all the write-offs, but I have to have supporting documentation so that everybody can sleep well at night. I just can't put a $10,000 expense if there's no $10,000 invoice to support it.
Yeah. Okay. So yeah, I need a lot of help in this area. I am not great with, maybe I shouldn't say this on a podcast, but I am not great with keeping track. Like at the end of the year, like now, I'm always scrambling to go back over the past year and look at all my income and expenses and create a P&L and blah, blah, blah. I can't always find receipts. Like I just need to be able to have an easy system to upload receipts and and keep track of that. Like, so I was looking at, the smaller version of QuickBooks, and at least to learn that, because I know that's easier for most accountants to just like transition into and see what you need there. But I want to dig into a little bit of what you were saying between the entity types, especially for people who are starting businesses with the thought of building wealth. And tax can be a really big wealth stealer if you are not strategic with what you're doing. So what would be, why should someone be an S Corp and why shouldn't they be? Or when is that point of transition from LLC to S Corp? When should you do C Corp? Is there anything you can share, like digging into on that a little bit?
Yeah, so when you're talking about just being an LLC, or even just a sole proprietor, say if you don't even have an LLC, because the purpose of the LLC is really to create some asset protection. Like it's not a tax saving mechanism. Because I can just be Larry Pendleton, CPA, and run my business that way with no LLC. If I write off this marker, like it's still a business expense. Like it doesn't matter if it's under an LLC or not. It's just I'm running a business that I can prove that is from that standpoint. Then you still want separate bank statements of business and personal bank statement, track all that. So once you can understand that the LLC is not going to create all these tax savings, you didn't understand that if you are just a single member LLC, which is a disregarded entity, all that's going to be reported on your Schedule C, pretty similar to if you're just a sole proprietor. So that's where that 15.3% hits the bottom line, like no questions asked, from there. And even if you're a partnership, you may file a separate business tax return and you get a K1, that's still considered a disregard entity because all of the income and all the tax is going to be hit on your portion of the partnership as well. Now, once you're actually, and there's a timing aspect as well, where like once you're growing and you're netting a certain amount of income, then it's time to kind of consult with your tax advisor of when to be an S Corp election. Because the S Corp election, once again, doesn't provide any legal protection outside of just an LLC. The purpose of it is so that you can now separate yourself from your business so that you are the employee of your business. Because as an LLC, you and it is the same thing. Even if you have a separate EIN number, like it's all going to be considered one thing. But if you're now separating yourself from your business, and that's what the S Corp election does, now you're paying yourself a reasonable salary, because at LLC, you can't pay yourself a salary. You can pay somebody else a salary, but you can't pay yourself. Now you pay yourself a separate salary. Your FICA taxes are all going to hit your salary. So if you're netting $100,000, your minimum tax bill, if you're just an LLC, is going to be $15,000 or $15,300 off the break. But now that, let's say you pay yourself $30,000 in that net income because you're now an S Corp, now that 15.3% is only going to apply to that smaller amount. The other 70,000 still rolls over to your personal tax return, but it's, like I said, it's not hit in addition to that. So you're already going to see tax savings by just making a certain election and running a payroll for yourself.
Do you have a recommendation or range for how much money you should be making before you try to be S Corp?
It ranges from CPA to CPA. My personal preference to keep things clean and simple is that if you are netting, that means after income and expenses, it's because you're taxed on your net income, not on your gross. If you're netting at least $50,000 consistently on an annual basis, you should be starting to make heavy considerations from an S Corp election. And the reason why is that it costs to be an S Corp. One, it's a separate tax return, so you have to pay for that. And you gotta pay for the K1s and the state filings related to that. Two, you like I said, you have to run a salary for yourself. Are you going to do your own payroll? Are you going to go through a QuickBooks or Gusto type of system, or are you going to pay ADP or Paychecks to do it? Like each of them are going to cost either money or time from that standpoint there. So, I mean, I know some other tax advisors they're higher in the range. Some may go up to 70,000. I know some that are low as 30,000. It all just depends on the individual. Yeah. And once you do that cost analysis of does the tax savings exceed the cost of doing the S Corp election?
So I know I've paid for a separate LLC tax return to be done. So isn't the LLC just as expensive then? Like, what's the difference between paying for an LLC tax return versus paying for an S corp tax return?
Now, is that a partnership tax return or just a single member? Because if you're just a single member LLC with no S corp election, you should not be filing a separate business tax return for your LLC.
Okay. So, all right, I have multiple LLCs. One is a single member, one is a partnership, but my single member is the partner of the other LLC.
Yeah, so you will end up filing a 1065 form 1065 tax return for your partnership tax return, and then your single member LLC would have got the K1, which would then report on your personal tax return.
Okay.
Now, also keep in mind that as just a LLC and your single member entity as LLC, like yes, there's the cost of filing that tax return, but then you're not required to pay yourself a salary from there. So you still have that aspect to it. And then if you're going to make that entity an S corp, then you have to make sure your partner is okay with being an S corp as well, because they may not be on board with that from there. So does that mean your single member LLC then have to be a S corp election, depending on all the different businesses and all the money you got coming in, and make that assessment from there.
Okay. Yeah, my brain already hurts thinking about all this. This is why you need a tax strategist and a great accountant like Larry to help you navigate these waters, because it can get complicated and there is so much benefit on the backside if it's done correctly. But you don't need to. And I know that's for new entrepreneurs or people who maybe have a W-2 and are trying to start something on the side, but they want to set up everything correctly. That's also an inhibiting factor sometimes, because it seems so overwhelming and you have to do everything yourself. It's kind of like the E-myth, though. You need to work on your business, not in it. But a lot of people get stuck working in it and can't grow and expand it to that level where you can even, consider being an S corp, right? So
it's also the concept of who, not how. The book by Dan Sullivan, where it's like we're so focused on how we can do it, where you're draining yourself and draining your time instead of finding the right who's that can handle certain things that you don't want to do. You don't find any value internally in doing it. But typically we're trying to pinch every penny and squeeze everything out in order but like at some point you have to bring in professionals in certain aspects that like you're not skilled at. I say like if you need heart surgery, you can cheaply try to do it yourself. I'm not sure how successful that's going to be.
Not as successful at all.
But you're better off going with professional. And I say, and we pick and choose when we want to do that. But there's nothing wrong about getting quotes from different tax advisors, same way you do with contractors, same way we do with bookkeepers. Like it's all the same. You just try to find who's the right fit that can understand what you got going on. You can grow with as well.
Yeah. So I really want from this podcast and the show to really kind of shine a light or let people really look in the mirror and see their own limiting beliefs and how that could be hindering them from employing strategies that could really catapult their wealth building, either through business, building a business or real estate or whatever that pillar is that they're using to create that capital, then to later grow and invest it. Mm-hmm. So I'm curious, because I really want to help minorities. I'm sure you have clients who, have a lot of minority clients and a lot of non-minority clients. I'm just curious, is there any difference in the way minorities think about taxes, or maybe not think about taxes, but in the way that we operate or how we're looking to either build wealth or the strategies we do or don't want that might be actually inhibiting us from moving forward faster? I'm not sure if does that make sense?
No, it makes sense. I think from what I'm seeing more often than not, it's because there's the racial component to it, but then there's also, okay, are we talking about lower middle class of non-minorities versus lower middle class of minorities? And it's like, okay, so a lot of times those worlds kind of think the same from that standpoint, where it's like this is just this immediate need for things and need to write all the write-offs and not really understand the long-term implications for certain things. Whereas the upper class and more often than not, it's like I said, the non-minority clients are kind of in that upper class, upper middle class, whatever you want to call it from that standpoint there. So it's like, okay, how do we now get into that spectrum of it there? And the main difference I'm seeing is really the people that they're putting around them. And like I said, people are always going to have, you're going to have negative influences and all that, but it's like, okay, who are you surrounding yourself with? Like I say, is it just going to be me and you talking with no attorney talking? Because if the legal stuff isn't in order, the tax stuff doesn't mean anything at all. Because the legal stuff gotta be structured together. So it's more often what I'm seeing between the different wealth classes, and sometimes even just between the different racial classes. It's just the aspect of being able to delegate, being understand, and also understanding like the bigger picture, like not what's immediate, what's good now. Like, yes, everybody wants to save on taxes now, but if you're just going to write off everything and you can't get a loan next year, then great. Like the taxes were great. Like you got a refund, but you're not really seeing the big picture from that standpoint there. So and also just a lot more and compiling of resources. I know people get into a lot of syndications and stuff now with real estate, but I just don't really see minorities kind of I don't see them as much. I'm not saying I don't see it at all, because I'm part of minority syndications myself, but I don't see that compiling of resources to buy a business or buy that property or whatever, so that no one's straining themselves, like they're leveraging the strength of their group, whereas non-minority groups are doing that more often. Yeah,
no, that's definitely true, and I think we see that in almost all the different industries, not just real estate. So that is a good point, that I feel like we need to come together more and form groups and communities where we can just work together to elevate, and we all elevate as a group. So I love that. I guess I kind of want to switch a little bit back to you and your journey. And once you started buying real estate, how that progressed from that first, I'm assuming that single family you bought was a flip?
No, that was a buy and hold.
Oh, it was a buy and hold. Okay.
So that one, like I said, I still have that one today.
Good.
The next property was a flip, and that was a crash and burn. That was a good learning experience on that one, and that's when I kind of learned, like, man, I'm taking on too much. Like, I had a full-time job. I'm growing the tax business. The property was an hour away. I'm over there like dropping stuff off during lunch. So obviously I'm taking 2-hour lunches and staying late.
I was just about to say that. Like, how long was your lunch break?
It was like a 2-hour lunch break. Then I go in early and I stay late at work, and then go to the property, and do some stuff, and then just not vetting the right team members and right contractors, and just getting glorified handyman from there. So, which is not a problem. It's just it's a time and place for everyone, and that wasn't a time and place for a glorified handyman. So like I said, I almost quit real estate just after the second deal, because like I said, I just wanted to kind of jumped in, wanted the big check and all of that, and it's like stay steady, stick with the rentals. Overall, the tax benefits are better in the long run. Plus, like I said, I was still in position to still get loans and all that because of me, and like I said, just being able to still having the W-2. So then about 2018 came across Michael Blanc, and because I knew I ended up buying like a duplex and buying some other single family rentals, and it's like, okay, the scalability isn't there, but I don't want to go back to flips. So, and then that's why I learned about multifamily, like large multifamily, just not like the little duplexes, triplexes, which is like fine. Just still stacking those up along the way, and still got some in the portfolio today as well. but really wanted to like get into like, hey, how do these syndications work? How are people buying, or what people assume is that how this one person bought this apartment building is like, okay, no one out here just choking out a check by themselves. And that's what I kind of learned more about. Hey, if you can find the right deal, like people will invest into it, and if you can't find the people to invest into it, then it's either a bad deal or you don't have the right people around you. And that's where it kind of took off from there, and just kind of networking with different groups, offering my tax services, but also the opportunity to put my foot in the door, being a GP, in some of these deals.
Wow, that's great. Okay, so we were talking a little bit about having that larger vision and having that long-term plan, and making decisions not based off of like immediate gratification. And you pushed past the horrors of your first flip. But what was your long-term plan, and where are you in that? Like, are you close, or what's your progress towards the long-term plan, and what was that plan?
I mean, my long-term plan is always tied into my mission, and which is, like I said, to help people achieve financial freedom through real estate and taxes. So in order to do that, I need to open up my own time. I need to free up more of my time. So that means I need to create more passive cash flow coming in, and I can do that through real estate. I mean, I can do that with the tax business as well, as just kind of scale up. But at some point, I'm not going to be filing taxes forever I tell all my new clients that like I'm not your 10-year plan. Like if I'm still doing this in 10 years, I screwed up somewhere. So it's still kind of building that cash flow. Like, okay, getting the bigger deals, and I'm also in the mindset where I'm happy to take 1% of every deal if that's the only bit of effort I'm doing. Like if I'm just doing like, hey, I'll discount my fee for a GP portion here, then fine. Like I can do that all day, every day, without having to worry about getting too much involved in capital raising and investor relations and property management that I definitely don't want to do at all as well. But like but also learning that like, hey, I could raise capital, I could talk to investors and present deals and all that as well. So that's where my long-term vision was like, hey, is it helping me serve my mission? If not, then I need to reassess what my plan is, because if it's not walking me in that direction, then I'm not creating passive cash flow to open up my time so I can do more educational support groups and all that there.
Wow. Nice. I love that mindset of always being okay with taking a small slice of a watermelon than trying to get the whole apple. Right. So that's great. And so many things that you said throughout this conversation is just so true. And that's why I want these conversations so that people think about long-term, because I definitely had the issue where I was trying to purchase something and my DTI was too high because I was trying to take off too many write-offs the year before. Like if you looked at my W-2, it was fine. Like I made enough. My debt to income was fine. But when you look at my taxes, I don't even know what I was writing off because I have no clue. I didn't own anything. So I don't know what I was writing off. But it really does affect your next steps and what your plan is. And if you're not conscientious about that, because I know a lot of wealthy people, they don't want to get a tax return. That's not in the thing. They don't want to pay taxes. They want to just zero out, because a tax return is basically like an interest-free loan to the government. And some people think, okay, well, that's like a forced savings plan for me, because then I'd rather just get that money back. But then that also means maybe you're not great with your money management during the year if you have to force somebody to make you save, but then you get that money and you buy something consumeristic with it anyway. So there's just so many different things behind that one statement by itself, right? But I love it. So wait, don't go yet. Have you been looking for a way to get started in real estate investing, but you just don't know how? You need the Launchpad. It's brought to you by my company, Norvest Holdings. And the Launchpad is a free guide with a ton of resources I've compiled to help you invest into your first real estate syndication. It includes terminology, book resources, video explanations, all the information that you need. Don't know what a syndication is? I got you covered. How to find a good operator, how to even tell if a deal is good or not without having to know how to underwrite it all. It's all in there. The Launchpad is designed to help launch you into the next stage of your investing career and get you invested into your first multifamily syndication as a passive investor, meaning you can be a landlord and own a piece of a large apartment building, but still go about your day-to-day life without having to stop and learn every single detail about what's under the hood and how it all works. The link to the guide is in the show notes. Make sure you sign up today. Again, this is a free resource and guide. And if you have any questions at all, please feel free to reach out to me. Now let's finish up the show. I'm actually going to ask you now, we're wrapping up to the end, and I'm going to ask you a question that I ask all of my guests. Number one, Warren Buffett said that diversification is protection against ignorance. What do you take that to mean?
There's definitely some truth to that, because you can only understand but so many things. Our minds are great, but it does take shortcuts. So if you're trying to invest in real estate and then invest in oil and it's like, okay, now you're investing in precious metals and all of that. Okay, do you truly understand what you're investing into? Now, it's okay to invest in those things, but a lot of people just kind of jump into crypto. Like, I still have no clue what's going on with crypto. I'm trying to learn from people that they're smarter than me, involved with it. But I'm not going to dump as much money into that. Then, like I said, but I'm also able to diversify within real estate, though. Like, I may not just do all apartments. I may do do a note investing. I do hard money lending for flippers and all of that, but that's still, for me, the same concept of diversifying, but all within the same niche. So it's like, there's some truth to it, but it's like, okay, but can you diversify within a niche itself? So
yeah, no, that's very true. So, okay, perfect. I love it. And second question, you've played Monopoly before, right?
Yes.
Okay. I'm really waiting. I said this before. I'm waiting for somebody to say no, because I'm going to probably side-eye them real hard, but I'll have to come up with an alternate question. But
most likely, somebody said no, that means they did something like really bad that game and started a family fight, and they don't want to
they don't want to admit to it.
That's basically what that means, because I imagine everyone has played that game.
Okay, so in your strategy for Monopoly, are you going for Baltic Avenue or Boardwalk, and why?
I'm going for Baltic because they'll at least give me enough and still keep me with enough capital to buy. What's the red street?
Crap. Is that like one of the Connecticut's or something? Is Connecticut red?
I think Connecticut is light blue.
Oh, see, I'm all off. I don't play Monopoly.
The red is like on the third row, like before you get to the Baltic line, get to the Park Place. So I'm not really big on just kind of maximizing everything on just one. So at least Baltic, even though it may be considered C or D class in real estate terms, it at least allowed me to have some, like, to keep some capital, get some cash flow, so I can now get to other areas.
Yeah, no, that's true. And you know what? C and D, they kind of actually they cash flow pretty well. Not in Monopoly, but in real life they cash flow. But they have a lot of other problems. So you gotta
you gotta know
what you want with that.
You gotta know what you're getting into.
Oh man. Okay. Wow. Great. This was an excellent talk. Thank you so much for joining me. I want to give you the opportunity to let the listeners know where they can reach out to you, either if they want to talk about maybe being a client or even just connect with you.
Yeah, I'm on all the social media networks, on Facebook, LinkedIn, Instagram. I dabble into Twitter, but really not too much there. If they want to take a QR scan of this code right here, they'll take you to my personal page where you can book a consultation meeting or book a free intro meeting. I'm also open to sharing my number, 757-535-8592. Shoot me a text, shoot me a call. If I don't respond, give me about 48, 72 hours. Because like I said, I like to just kind of meet new people and see where I can be of value.
Nice. Okay. I wonder who wrote down that phone number. but you have to listen again to get it. But all his other links to his social media profiles will be in the show notes. And if you are not watching the video, you don't see the QR code, but go to the show notes. The links will be there. And thank you so much, Larry, for joining us today. It was great. And we got to keep in touch.
Thank you, Nicole. Looking forward to it.
All right. Good luck with everything. Bye, everyone. Thanks for joining us today.
Did you love this episode of Share the Wealth Show? Be sure to connect with Nicole by following her on LinkedIn, Instagram, or Facebook. If you picked up any of the gems that were dropped by today's guest, make sure you not only put them in your bag, but if you know of someone who would benefit from this information, don't keep it to yourself. Share the wealth and make sure to leave us a rating and review. We'll see you for next week's episode. Subscribe so you'll be notified.